Hello and welcome to the Horizonte Minerals call. Just as a reminder, make sure that you have accessed the presentation link that has been provided to you. Throughout the call, all participants will be in a listen-only mode, and afterwards there will be a question and answer session. Today, I am pleased to present CEO German Martin and CFO Simon Rudder. Please go ahead with your meeting.
Good morning. Good to give you a presentation on the vermelho pre-feasibility study. Hopefully you've all got your presentations in front of you, and we will just work through page by page. Moving to page 4, just to highlight for those of you who are not aware of the company, we're a multi-asset nickel company focused in Brazil. We have two 100% owned assets. The focus of today's presentation is the vermelho nickel cobalt project. This was a strategic acquisition from Vale. We acquired this 18 months ago. It's within trucking distance of Araguaia. Vale had completed a full feasibility study on the project. We estimate over $200 million of spend, and we acquired that for $8 million with $2 million up front. The release of the pre-feasibility study today demonstrates a robust set of economics at current nickel price, and it demonstrates that vermelho is a tier 1 asset in terms of low cost, high grade and scalability. Previously we had a call where we talked through the Araguaia feasibility study and funding as Araguaia moves forwards to construction. This is located approximately 85 kilometers south of vermelho. The feasibility study numbers are robust around Araguaia, and we're currently working on the funding package to start construction mid-next year. The other key thing about this portfolio is its alignment with the current nickel market fundamentals. Supply and demand side is robust, and there's also a significant new growth driver around the EV battery market. Moving on to page 5, this shows our region that we operate in Brazil. We're up in northeastern Brazil in the Pará state, and we are around and south of the Carajás mining district, which is a major mining district. Vale have a number of world-class iron ore and copper operations, and as a result of this, the infrastructure is extremely good with hydroelectric power, road, rail, and access to good skilled, high-quality labour. We have, on this map, Araguaia is shown at the south of the slide with the stage 1 and stage 2 ferronickel operation, with the potential to produce around 30,000 tonnes on full ramp up. ANN, in the centre of the slide, is the Glencore cluster of deposits that we acquired, and then to the north of the slide in red is the vermelho nickel cobalt project, which is focus of the pre-feasibility study today. So the key thing is around this portfolio we have over 400 million tonnes of resource, and the potential between two production centres, one at Araguaia in the south and one at vermelho in the north, to produce over 50,000 tonnes of nickel. And this would put you around the 7th or 8th largest nickel producer worldwide. So it is a very unique opportunity that the company owns today. Moving on to page 6, if we look at the highlights for the 43101 compliant pre-feasibility study that we released today, in terms of net present value, we used a nickel price of 16,400, which is our base case. Nickel price today is around 16,600, so this is economics at today's nickel price. The net present value is around $1.7 billion. It generates an internal rate of return of 26%, and after payback of capital over the 38-year mine life, it generates $7.3 billion of free cash flow. So it's an extremely cash generative asset. If we look at a snapshot into the nickel market, a number of key factors here. LME nickel inventories as of this week have dropped to their lowest levels in the last 7 years. So we're actually around 91,000 tonnes of LME inventory. We've seen sharp drawdown in the last month. We also have a strong demand picture from two areas. One from the traditional stainless steel market, which accounts for 70% of nickel use today, and then the other new significant demand areas from the EV battery market. And if we look at the demand pictures there, 2030 is the main EV penetration point, and we're looking at around 30 to 40 million vehicles globally. And this translates to anywhere from 500,000 tons to 1 million tons of new nickel, which, based upon current nickel supply of 2.2 million tons, is a very significant driver. The other factor is the lack of investment in the nickel space over the last 10 years. There are very few high-quality, large, scalable assets that have the potential to come online in the short term, and that is why Araguaia and Vermelho are so uniquely placed. And it's worth looking at UBS undertook a piece of research, and they looked at 40 or so of the global nickel projects that have the ability to come online in the short term. That's either projects that have been on care and maintenance, feasibility study projects, or expansions to existing operations. And they determined that around half of those projects only returned a 15% IRR at $20,000 a ton. So it just shows you what sort of nickel price we need to incentivize any significant new production. If we look at slide 9, there have been a couple of short-term developments that really have had a positive supply on nickel. The main factor there is the Indonesian ban on direct shipping ore. This was due to come back into place in 2022, and in late August, the Indonesian government came out and said that ban is going to be brought forwards to the start of next year. And that really had the effect of moving pricing from the $14,000 a ton to the highs of $18,000 a ton that we've seen in the last 6 weeks. But more importantly, what it means is that by 2021, it potentially takes 200,000 tons of nickel offline, which means that we're in a deficit position at that point in time. So again, a positive development for nickel pricing. We're focused on Vermelho today. Vermelho is going to produce nickel and cobalt in sulfate. The main end use for that is as the catalyst in the EV battery space, and you can see here that the growth numbers around EV penetration are fairly significant, and also we seem to see that the main battery chemistry that people are adopting is basically high nickel battery content with around 80% in the battery there. And a typical EV vehicle now is using around 30 kilograms of nickel, which we're seeing up from where it was 2 or 3 years ago. Nickel sulfate in particular, we've seen the market evolve in the last 2 years for this. We are seeing a number of companies move over to producing nickel sulfate, and we're seeing significant amounts of class 1 nickel that was typically being used in the metal side for stainless steel, being moved across into producing sulfate, etc. So we're seeing a tightening of the market on that side. And we're also seeing nickel sulfate achieving fairly significant premiums above LME spot price. Now, this premium does move around, but for the last 12 months, that's been sort of over 10 to 15% premium over LME. Moving on to Vermelho in detail, I'm going to hand over to Simon to talk through the economics.
Sure.
So pre-feasibility.
So this is on slide 13. We'll talk through the capital cost estimate is 652 million, and that is for stage 1 capital expenditure. The process plant has been split into 2 stages, with the initial capex kept at a manageable level. That is a low capital intensity of $27,000 per ton of nickel per year, which is quite competitive and below the average, which is about 40,000. The post-tax IRR of 26.3%. As Jeremy said, that's at the current nickel price, and the bank consensus price of 16,400, and it generates a post-tax NPV of 1.7 billion at that price. It generates annual production of 24,000 tons a year of nickel in sulfate and 1,300 in cobalt. The waste is dry stacked, which is quite important in the current climate. So there is no tailings facility, which is obviously a reasonable worldwide issue at the moment, given the recent history. In addition to the cobalt and the nickel, there's also a very useful byproduct, which is called kieserite, which is a magnesium-based fertilizer. Obviously, agriculture is very big in Brazil, so we anticipate that having good economic and social impact on our project. Moving on to slide 14, we've mentioned a lot of the figures already. The most important one on this slide, I think, is the lowest quartile C1 cash cost figure of $7,300 per ton of nickel in the first 10 years. And that puts us firmly on the lower end of the cost curve in the bottom quartile, which is a very good place to be. Nickel's been quite volatile over the last 6 to 12 months, so that just protects us on the downside in case prices do come off a bit. And on the right-hand side of this slide, you can see what happens to the figures if we put in the long-term price forecast from Wood Mackenzie. So, going back to that, the post-tax IRR increases above 30% to 31.5, and the post-tax MPV goes up to 2.4 billion. So that is the forecast nickel price for when this project would actually come into production in a few years' time, which gives a potential upside to the project. Moving on to 15, which is the capital cost estimate. As I mentioned, this is for the stage 1 of the processing plant. Stage 2 capex is 447 million, which is due to come online and be financed out of free cash flows from year 3 onwards. So first production would be in year 4 for the second line. The first line, the breakup is set out on slide 15 with a significant portion, the majority of it is to do with the HPAL processing plant. So that's the leaching plant as well as the acid plant. So we're proposing to manufacture acid on site and import the reagents and the raw materials for that rather than importing acid. As Jeremy mentioned, the infrastructure is very good in the location that this project is based, and so there's minimal infrastructure costs as a percentage of the total. There's a small power line that needs to be put in, but generally the grid power, the roads, and the logistics for getting equipment in and out are a very high standard already. And in addition to that, there's obviously quite a healthy contingency given this is at PFS level. That stands at nearly 100 million.
Moving on to the flow sheet. We have spent a significant amount of time looking at optimizing this flow sheet. And if you go back to when we acquired this project from Valley, they were looking at a 46,000 ton a year flow sheet, which is effectively double where we have ended up in terms of our sizing capacity. So our objective was to take what Valley had developed, it was a very high quality standard of work that they had got to and data, but to re-engineer that back to a smaller flow throughput and smaller plant scenario with a lower capex hurdle and lower risk associated with the overall ramp up and development of that plant. So it's effectively, as Simon said, train number 1 is stage 1. It's effectively 1 million tons per annum throughput, which is fairly standard now for these HPAL plants, with the second train coming online year 3 into year 4 with all of the hard infrastructure covered as part of that stage 1. Standard upfront flow sheet through the HPAL autoclaves to produce mixed hydroxide, then upgrading, and then final refining step at the back end to produce your 3 product streams, your cobalt sulfate, nickel sulfate, and the kieserite fertilizer product. Dry stack tailings facility, obviously with the recent, Simon outlined the recent tragedy on the Brumadinho tailings dam, we focused hard on ensuring that this has the least amount of environmental and social connotations going forward. So We've worked with some of the leading groups in HPAL engineering to devise this flow sheet, and we are comfortable that this can deliver the throughput and outputs that we've designed. I think another key factor to mention on vermelho is its specific geological characteristics that it has, and it has the ability to upgrade the ore. So from run of mine through to the autoclave feed, you're effectively taking out a lot of the low-grade barren material, and as such, you end up with a very high-grade nickel feed into the process plant. And for the first 17 years, we're actually treating material over 1.5% nickel, which, if you compare that with all of its global peer group, would be one of the highest throughput feed rates in the market today. In terms of development pathway, the background to this slide just shows the vermelho deposits, V1 and V2, and the sort of the brown areas in front is actually a large construction site that was built by Vale for their S11D iron ore project. It's got power and water to site, and we see that as being a construction yard for the development of vermelho. The area is effectively scrub and secondary forest. This was never rainforest. We've got the town of Cana de Carajás is 3 kilometers away. We've got a 3-lane tarred highway within 1 kilometer of the project, and we've got power and water. So in terms of development, it is an extremely easy asset to develop. So far, obviously, acquisition complete, initial updated resource complete, test work to produce battery-grade product complete, pre-feasibility announced today. We have some additional work to now undertake, which involves some specific piloting around some aspects of the flow sheet, updated work on the geological model and the upgrading step, advance the permitting, and then into full feasibility. So to conclude, the key highlights around the vermelho project. It's located in a mining region, extremely good infrastructure, and there will be cost synergies between vermelho and the Araguaia project in terms of operational team, freight, and general operational costs between the two assets. Vermelho is an extremely high-grade, scalable resource with these specific geological characteristics that allow you to upgrade. There's been a significant amount of high-quality work that we acquired, over 150,000 meters of drilling, a lot of very detailed piloting, and this has flowed through into our pre-feasibility study that demonstrates robust economics at today's pricing. If we look to benchmark vermelho with other assets in the marketplace, page 20 is a fairly standard plot, just showing effectively grade and tons. And it's actually showing the contained nickel within a number of our peer group companies. Probably one of the most advanced is Cleantech in Australia and Australian mines. And you can see there Cleantech has around 550,000 tons of contained nickel, and vermelho has 1.6 million tons, so nearly 3 times the size. And if you look at the grades, you're looking at sort of 0.6 to 0.7 in situ resource grade, where vermelho is closer to 1%. And then a 1% nickel, and then with that upgrading step, you're getting up to 1.5% nickel. So all of that has a massive driver on your economics. Page 21 just shows where vermelho would sit on the global Brook Hunt cost curve. This is all global nickel laterites, and at $7,300 a ton, you would be in the lower quartile. And again, that comes back to our focus as a company to develop both Araguaia and vermelho to sit at the lowest point on the cost curve and be one of the lowest cost next generation opportunities in the mining space. Again, a couple of metrics here. If we compare this to Cleantech again, obviously lower upfront capex. Vermelho is 650 million versus 1.4 billion. Capital intensity, vermelho will be around $27,000 a ton versus $76,000 a ton. Amount of nickel produced, vermelho will produce 24,000 tons versus 19,000 tons. And just looking at the reserve grade, you can see there 0.56% at Sunrise versus 0.9% at vermelho. And you can put vermelho against any of the peer group assets, and it is able to outperform on any of those metrics. We just want to re-highlight the Araguaia project, which is obviously a key part of this story. And looking at the Araguaia feasibility study economics at today's nickel price, or at the same set of economics that we're running on vermelho. And you can see there the stage 1 ferronickel project is giving you a 27% IRR, $2.4 billion net cash flow after payback of capital, and an NPV of just under 700 million with a payback of 3 years. So between these two assets, at current nickel price, we've got over $2.5 billion of NPV between the two assets. In terms of development on Araguaia, we announced the successful completion of the $25 million financing with Orion on the royalty transaction there. We're currently advancing the project finance piece with the commercial lenders, and moving through the end of the year and into Q1, you should see updates around syndication of the banking groups, movement on offtake and award of offtakes, and moving through to our target of having a financing packaging completed by mid-next year to start construction. So really just to conclude and pull this together, Horizonte is a pure leverage nickel play. We provide direct exposure to nickel. We have two high-quality, scalable assets that at current nickel price demonstrate extremely compelling economics. We're well funded. We've got around $30 million on the balance sheet today, and also that brings Orion on as a potential downstream funding partner. Both projects are within trucking distance of each other. They're in a mining district. They've got good proactive government support, and we have the ability to build a major nickel business here. We have 400 million tons of resource, all within into trucking distance of each other, with the potential for two plants, one at Araguaia, one at Vermelho, to produce 50,000 tons of nickel. Araguaia producing ferronickel for the stainless market that's real today, and Vermelho to produce sulfate for the growth in the EV market. Major shareholders are led by Teck, who have got 14% of the company. Glencore own around 6%, and then we have a number of other London institutions. So this is a well-supported shareholder group. Market cap is around 65 million. We have good daily liquidity, and we see a number of milestones coming forwards to drive that share price as we advance both assets. In terms of team, we've evolved the team with the announcement of a project director for the build-out, and you'll see further team members joining the Araguaia development team. And we have a board and management who has built and operated mines in South America. So we have the ability to take Araguaia forwards to construction and production. And that brings us to the end of the presentation and opens up to any questions. Thank you very much.
If you would like to ask a question, please press 01 on your telephone keypad. If you wish to withdraw a question, you may do so by pressing 02 to cancel. That is 01 if you would like to ask a question. There will now be a brief pause while questions are being registered. And our first question is from Michael Stoner from Berenberg. Please go ahead. Your line is open.
Morning. I've got a couple of questions, predominantly around costs, and then a couple on other topics. But just having a look at your kind of really, really strong cost base for the first 10 years. Is the kind of step up in costs after 10 years only driven by grade, or is there any other structural drivers of that?
No, it's principally grade. So obviously we've focused the mine schedule to optimize the highest grade areas during the first 10 years to cover payback. You're also running a significant mining profile where you're effectively building stockpiles that you start reprocessing later in mine life. So you do see a tail off in grade towards the later years of mine life, which affect your costs.
Okay, understood. And what does the OPEX look like before your second HPAL line comes in and the scale steps up?
It's broadly similar. Yeah, it's broadly similar.
And the reason for that is that you're running plus 2% in the first 4 years.
Okay, so the kind of fixed cost dilution that comes with the bigger scale is kind of traded off with grade, and we should see it about flat.
Exactly, yeah.
Yeah, okay, perfect. And then I appreciate the strategy for this project is focused on supplying the battery industry, but how much optionality do you have if you see better pricing or kind of better returns from serving the stainless steel industry? Could you or would you consider the RKF processing route?
Yeah, I think that's a very good question. And if you go back to what first attracted us to this project is we were looking at this as a high-grade feed for the Araguaia ferronickel plant. And actually, if you look back at the evolution of this project, the original plan was to be a standalone ferronickel operation. It's a unique ore body that you can effectively apply either process route. You can put the RKEF technology there, or you can put the HPAL process. And we have actually run in parallel to this sulfate HPAL PFS. We run an internal RKEF scoping study, and the economics are equally compelling. So that is the neat thing, that if in 3 or 4 years' time Araguaia is producing, and actually we're seeing a significant shortfall in ferronickel, and we have a team, we've de-risked it, and we've demonstrated we can do it, and there are other sulfate sources coming online quicker than the market has planned, this can quite easily be developed as a ferronickel operation, and the economics are as compelling as the HPAL route. So that's the key thing, it's got flexibility.
Okay, great. And would it ever make sense to kind of have a line of each, or the capital intensity of that would not be as attractive?
I think people have talked about it, and definitely I know Anglo American have looked at having an RKF facility where you then bolt in an HPAL line, and there are synergies between hot transfer of material and being able to generate energy from the hot slag. I think at this stage it's probably a step too far for us to be considering, but that may well be something in the future. And again, if you look at Araguaia, I mean, we have a large limonite resource there that we're mining that we're not treating, and there's no reason why in the future that if technologies evolve, tank leaching, atmospheric leaching, or even a small HPAL train, that couldn't be applied to that site, because effectively you'll have a resource sitting on surface on a permitted mining site at no cost. So absolutely you've got the future options to do that.
Okay, and then on your sulfate product, how much sensitivity is there around purity from off-takers, and did you get through their hurdles comfortably in the met testing?
We did. I mean, we produced nickel and cobalt sulfate kind of around, I think, 20.3 to 20.5%, which is in the ranges. I mean, it is a fairly fast-moving arena. What that purity range will be in 2 or 3 years' time, I think we've got to keep evolving that, and it may be that actually you find that as this moves to feasibility study, you reassess whether producing final sulfate is the right market outcome, and you may produce an intermediate product. But that's the neat thing about the flow sheet. You can effectively take that back end step off, which would reduce your capex and produce an intermediate product. Okay,
and last one from me, if I may. What sulfate premiums to LME did you assume?
So we got a market study undertaken by Wood Mac, who looked at the premiums over the last 12 months, and the average was $2,000. So we have assumed $2,000.
Okay, perfect. Thank you very much. Cheers for your time, guys.
Thank you.
And just as a reminder, if you want to ask a question, please press 01 on your telephone keypad. That is 01 if you would like to ask a question. There will now be a brief pause while further questions register. And our next question is from Juan Law from Shore Capital. Please go ahead. Your line is open.
Hi, guys. Congratulations on the results. Very good to see. Much better than I expected. Can I ask about the licensing? Do you have to redo the LP or LO? Or?
Yeah, good question. So effectively, this was obviously fully permitted in 2005, the full environmental permit was actually archived, and yes, we need to reapply and obtain the LP and the LI. The key thing is we've got a very high quality data set. We've already started updating the baseline data and documentation, and we've reapplied for the LP, and we will effectively be reactivating that process, but we've got a very good basis to do that on.
Well, given that you've got this very good base, I mean, have you looked into what the timings might look like?
Yeah, I mean, if we use Araguaia as a benchmark, I mean, effectively the LP process was 12 to 18 months, and the same for the LI. But bear in mind that didn't have any baseline precedent data, and also we were running that process probably slower than optimally, just based upon market conditions. So we feel that we can get through the LP-LI process in a relatively quick time frame.
Okay, thank you.
Thank you.
And as there are no further questions, I will hand the word back to the speakers for any final comments.
I don't have any other further comments on our side.